Gold is speaking. Are you listening? You need to pay a close attention for what I'm going to say. For centuries, gold has been more than just a metal. It's been a signal of fear, uncertainty, and opportunity. Right now, that signal is getting louder. Despite minor pullbacks, gold remains near its record high of $4,400 per ounce. Around the world, investors are watching closely. Why? Because gold isn't just reacting to markets, it's predicting them. In this video, we're going to break down why gold prices are climbing right now, what global experts from the US and Europe expect next, simple strategies for when to buy and when to sell, and how to use gold smartly, like an investor, not a speculator. Stick with me to the end, because I'll share a clear buying strategy, selling triggers, and realistic price zones you can watch right now. Part 1. Why everyone's talking about gold. Let's start with the obvious question. Why is gold suddenly the star of the financial world? Several forces are pushing gold upward at the same time. First, global uncertainty is rising. The ongoing US-China trade war, conflict in Eastern Europe, and political instability in multiple regions have shaken investor confidence. When people fear risk, they rush to safe havens, and gold is the oldest safe haven there is. Second, central banks are buying gold like never before. According to recent IMF data, central banks bought more gold in 2024 and 2025 than at any time in the past 50 years. Why? To protect their reserves from currency volatility, then currency weakness and inflation. When the value of paper money falls, because of inflation or debt concerns, gold tends to rise. It's not tied to a government. It doesn't default. That's why people trust it. And finally, investor sentiment. Institutional and retail investors alike are adding gold to portfolios to balance risk, especially as interest rates remain uncertain and equity markets flash warning signs.
As Michael Reynolds, chief market strategist at Stonebridge Capital Advisors in the US, recently said, "Gold doesn't follow the crowd. It tells you when the crowd is scared."
Gold has surged to around $4,400 per ounce, an all-time high. It pulled back slightly, closing around $4,270. But here's the key: the momentum hasn't died.
European strategist Sophie Lemaire from BNP Paribas explains it simply. A strong rally followed by a shallow correction isn't weakness, it's a sign of strength.
Technically, gold is trading in a strong upward channel, bouncing between support around $4,000 and resistance near $4,400. If prices stay above $4,000, the bullish structure remains intact. A break above $4,400 could lead to the next leg higher. But if prices fall below $3,900, it may trigger a deeper correction, a window for buyers. Part 3. What experts are seeing ahead. Experts are not all agreeing on the exact price level, but they do agree on the direction.
I expect gold to stabilize near $4,100 before another upward push. Institutional demand is too strong to ignore.
Short term, we'll likely see gold moving between $4,100 and $4,300. But every global headline, whether it's about interest rates, trade wars, or elections, can shift it fast.
For the next 9 to 12 months, we're bullish. Gold isn't just trading like a commodity, it's trading like a global currency.
What's behind these views? Central banks continue their gold accumulation. ETFs backed by physical gold are hitting new records. And inflation expectations remain stubbornly high. In plain English, institutions are buying dips. Retail investors are following the trend. Governments are quietly increasing their gold reserves. That's a powerful mix. Part 4. How to think like an investor, not a trader. Before we talk about when to buy or sell, we need to shift the mindset. Too many people treat gold like a lottery ticket. That's a mistake. Real investors use gold for 3 main reasons. One is to protect purchasing power. means gold historically maintains its value when paper currencies fall. It's a hedge against inflation. 2 is to diversify their portfolios, because gold often moves inversely to stocks and bonds, so it smooths out volatility. 3 is to prepare for crisis scenarios, like when uncertainty hits, gold often spikes. This isn't luck, it's capital moving to safety. So when you think of gold, don't think quick win. Think insurance policy for your wealth. Part 5. When to buy gold. Alright, here's the part everyone wants to know. When to buy. 1. Buy during corrections, not at peaks. Don't chase gold when it's spiking above all-time highs. Instead, wait for natural pullbacks, like the current dips between $3,900 and $4,100. Why? Because markets move in waves. Even in strong uptrends, prices often retrace before climbing again. Buying dips gives you better entry points and lowers your risk. 2. Buy when fear is rising, but before panic sets in. Gold rallies when inflation data surprises on the upside, or central banks sound cautious, or political tensions increase, or stock markets stumble. When those warning signs flash, that's often when smart money steps in. 3. Buy in stages. Instead of going all in, consider buying in 3 to 4 smaller tranches. This reduces timing risk. If gold dips more, you still have room to buy lower. 4. Use gold as part of a balanced plan. Experts recommend allocating 5 to 15% of your portfolio to gold, depending on your goals. This isn't financial advice, but a general principle many long-term investors follow.
The best gold investors aren't chasing the market. They're building a position quietly.
Buying is important, but selling smart is what protects your profits. Here are realistic sell signals to watch for. 1. Sharp rallies on weak fundamentals. If gold suddenly spikes well above $4,400 or $4,500 without any strong macroeconomic reason, that could signal speculative froth. That's when many smart investors take partial profits. 2. Falling inflation expectations. Gold loves inflation fear. But if inflation data falls sharply and stays low, gold demand may soften. That's often a short to medium-term sell signal. 3. Rising interest rates without fear. If central banks hike rates and markets stay calm, gold can cool off. That doesn't mean a crash, but it can trigger a downward trend. 4. Strong risk-on rallies in stocks. When global markets rally hard and investor fear fades, gold may stall or pull back as money flows into equities again. 5. Reaching preset price targets. A disciplined investor sets targets in advance. Example: buy near $4,000, take partial profit at $4,500, final exit near $5,000. This is how professionals lock in gains.
You don't have to sell everything at once. The best exits are planned, not emotional.
Let's wrap up the strategy side with some practical, real-world tips. 1. Timing is helpful, but time in the market matters more. Means long-term gold holders have historically outperformed short-term speculators. 2. Think allocation, not obsession. Means that gold is a tool in your portfolio, not the whole plan. 3. Stay calm during corrections. You need to know that gold has always had pullbacks, even in bull markets. Smart investors buy quietly during fear. 4. Follow macro signals. Inflation data, geopolitical news, and interest rate decisions move gold more than day-to-day noise. 5. Use trailing stops or profit targets. Means that if you're trading, protect profits with a clear exit strategy. 6. Don't chase hype. If everyone is screaming buy gold, you need to understand that you're probably late. Part 8. Final thoughts. Gold's role in a shaky world. Here's the truth. Gold isn't magic. It doesn't solve every financial problem, but gold is reliable. It's been a store of value for thousands of years, through wars, recessions, inflation spikes, and currency collapses. Right now, the world is uncertain, and uncertainty is gold's natural habitat. If you buy smart, during corrections, with patience and a plan, Gold can be a powerful shield in your portfolio. And if you sell smart, at planned levels, not in panic, it can also be a profit engine. So ask yourself, are you listening to what gold is trying to tell you? If you found this video helpful, don't forget to like, subscribe, and turn on notifications for more weekly financial education. Before we wrap up, here's something important to remember. I am not a financial advisor. The information in this video is for educational and informational purposes only. Any investment you make is your responsibility, and it carries risk. Always do your own research or consult with a licensed financial professional before making financial decisions. Thanks for watching, stay smart, and invest wisely.